RSUs. Here we go. So we're talking about financial planning. Every financial decision you make is part of your financial plan, whether you know it or not. And what I mean by financial plan is the fact that you're going to have a financial life. You're going to live so many years. You're going to have financial things happen in and out during your life. It's going to happen. You're going to interact with your finances. There's no way to live without doing that. The question is, do you get to do everything you want in life? And are you able to afford that? And there's really only two answers. I call them door number one and door number two. Door number one, going through that door, is affording everything you want to do in life. Door number two is not. I can tell you this with a high degree of certainty. Without a plan, you're much, much, much more likely to go through door number two. With a plan, you are not guaranteed door number one by any stretch of the imagination, but you improve your chances to get what you want out of life financially if you plan for it. And so what do I mean by plan for it? Well, here's how I think about planning. There's four different areas. First, protect what you have. That's your insurance, your estate planning, all of that. Know where it goes. That's your spending, super important. If one of your goals is to maintain your current lifestyle, you should know what your current lifestyle costs. So know where your money is going. Number three, make it grow. That's investments. That's what we're focused on today. Retain independence and dignity. That means we're not going to live off our kids in our old age. We put all four of those areas together with intention and purposeful effort to build your best financial life. Not the best financial life on the block, not the best financial life of your friends, but the best one, the one that's right for you, given your resources and what you want out of life. Now, this is our process that we go through with clients, but I wanted to bring this up because you can see I've highlighted how low down the list investments are. Everybody wants to talk investments. Everybody wants to think about investments. It's the sexy part of financial planning, but you can't really make smart decisions about your investments until you do some other things, like understand what it is you want out of life, where you want to go, what you're investing for, what your upcoming expenses are. That tells you how much to keep in cash and what your portfolio should look like, what your risk tolerance is, all of those things. So we go through this entire process, but investments are really, they come later in the process by definition. Okay, so here's what we're going to talk about today. What is an RSU? Why should we have a process to sell our stock, company stock, RSUs, whatever it is, but just company stock? And then I'm going to talk about a little bit about a tax smart way to do this. So what is an RSU? An RSU stands for restricted stock unit. This is a representative of a share of stock. So it's not an actual share of stock until it vests and it's in your account. These are awarded typically annually, sometimes semi-annually, and then they vest over a period of time later. So when they're awarded to you, you might think you own it, but you don't. You don't own anything until it actually vests. And so on the vesting date, that's when you're taxed. That's when you take ownership. So that's when the IRS says, aha, you just got compensation. I'm going to tax you on that. After vesting, you can sell or hold it or do whatever you want. And typically the unvested shares, if you leave a company, whether it's your choice or not, the unvested shares will disappear. So you don't get to take those with you. All right, the question, when should I sell? Well, obviously you should sell when the stock is high, right? No, really. That is the truth. It's impossible to know when that's going to be, but that's the only answer that makes sense, right? So if we can't know when the stock is high, then we've got to figure out another way to sell. And here's what most people do. What most people do is they'll say, well, my stock's been going down, so I don't want to sell. I'll wait till it goes back up. That's what they say while the stock's coming down. Then when the stock goes up, they say, well, I don't want to sell while it's going up. I want it to keep going up. And so by default, they're not selling when it's going down. They're not selling when it's going up. Their strategy, whether they know it or not, their strategy is to never sell. And so they just hold it. Even people who watch the stock very, very closely can get caught up in this trap. That is not a good strategy, clearly. We want to have access to our wealth. This is part of your compensation. You want to be able to integrate it into the rest of your life. You don't want that to be driven by some immediate need for cash, Because if you do that, then you're taking risk all the way up to the point where you have that emergency need, and that's not good either. So here's what I suggest you do. So when should you sell? Think about these three things. So first question, when will you use the funds? And by use, I mean spend. When will you actually spend the money? If you're going to spend the money within the next 5 years, I would strongly suggest you consider selling today. There is no way to tell what the market's going to do over the next 5 years, what an individual company is going to do over the next 5 years. And if you've got money in your RSUs that you're going to use for a down payment for a home in 2 years, or in a year, or in 3 years, you don't want that decision to be at risk to the markets or your company's performance. Here's the worst case scenario. Markets crash, housing market crashes, houses are really cheap now, but you don't have any money to go out and buy one. You were all set to buy a house and now you can't. We don't want to have our future near-term expenses at risk because we've got money in the markets or in our company stock. Number two, what does the rest of your portfolio look like? I'm going to talk about this a little bit more in a moment, but if your company stock is more than, this is kind of a rule of thumb, and I hate rules of thumb, so please forgive me. But if you force me to give you a number, 10%. You don't want company stock to be more than 10% of your long-term portfolio. If it is, consider selling now. Now, realize part of the reason that that number might seem so low is you've also got your income coming from your employer. So if you have all of your wealth or a large chunk of your wealth and all of your income coming from your employer, and then the employer falls on hard times or there's some scandal or whatever, there's a problem, you might lose both. We don't want to be in that situation. You work too hard to get this wealth in the first place. Let's not put it at risk in that way. So just as a starting point to start thinking about whether you should sell in terms of how much you have, don't think about it in terms of dollars, like $100,000 or $10,000 or $200,000. Think of it in terms of the percentage of your overall wealth. And I mentioned we're going to talk about that a little bit more. Number three, even if neither of those are true, even if it's less than 10%, you're not going to spend it, I would still consider selling. And here's why: diversification is the key to success. Concentrated positions can make you very rich, but they can also go to zero. And we're not trying to get rich with our investment portfolio. If we are, that's speculating, that's gambling, that's a whole different thing. I don't work on speculations and gambles. I have no way to advise people on those. If you want to do it, that's great, but realize that's all you. We don't want to. I don't want to be advising that, and I don't expect anybody to be gambling their future that way. So let's talk about that 10% number, the percentage of stock. So here's a sample of somebody. So this is somebody that has stock, company stock. They have savings, they have a 401k, and they have a house. And so when we look at their total assets, we see that their company stock is 20%. They've got another 10% in savings. That's probably about right? About double the amount of stock as you have in savings. And then some amount in 401k, here's 30%, and 40% in the house. So 20%, is 20% of your total assets too much? Well, maybe not, but let's look at this. Now we've got this house out here. Can we actually spend our house on our regular living expenses? Well, you could probably take a loan out, increase a loan, a home equity line of credit, but really you don't spend your house really during your life. So let's take the house out and let's look at our financial assets, okay? So of our financial assets, same person, same dollars, but see how the percentages changed. Now the company stock is 1/3 of the total financial assets. And we've got savings and we've got 401k. Well, if this person's not over 59.5 years old, they can't spend their 401k. The money putting in the 401k, which is great, should definitely do that. Take the tax benefit, save for retirement, please do that. But realize that's not money you have access to. We don't want to take a loan out against it, because then you're paying yourself interest, which is basically just taking money from one pocket to another, and you're taking time out of the market. You don't want to do that. So we can't really include this 401k now, can we? Because we're not spending that on our lifestyle. It's not really available to us. So let's take that out. Now we're looking at our liquid assets. Well, gee, now look at the company stock. Same person thought they had 20% in company stock. Really, they've got 2/3, 66% of their liquid available assets, money available to pay their bills, in company stock. Is that too risky? I don't know if you agree with my 10% number, but my guess is you might think that 67% is a bit high, no matter how much confidence you have in your employer. So really look at your situation and understand what's available for you to spend. And if the worst should happen, if you should lose your job or what have you, the stock goes down, how does it really affect you? So we've got to dive into those details to understand. All right, now what about taxes? Well, I touched on this a little bit earlier. So as RSUs vest, when they vest, you get taxed, okay? And you get to keep stock. You probably have noticed that they automatically sell some shares, right? That goes to the IRS as withholding, just like when you get a paycheck, some of the money goes to the IRS as withholding. That's what's happening there. Now, it's not the right amount. They never withhold enough, but that's kind of beside the point. The point is you're going to owe taxes based on the value of the date of vesting. Now, what's the difference in a company, the company giving you stock, it vesting and you getting taxed, versus the company writing you a check in cash and you getting taxed? There's really no difference. So if you are letting your vested RSUs, if you're holding those past the vest date, what you're doing is you're taking a paycheck and turning around and buying stock. You're putting 100% of that paycheck back into the stock. That's what you're doing. Would you ever do that with an actual paycheck? I would guess not. So you're letting you're increasing this risk in company stock, and there's no tax advantage at all because you get fully taxed on vest date. So really consider selling those RSUs as they vest. That's really a no-brainer. If you want to start to pare down your stock exposure, I would definitely start there. Now, if you have older RSU positions, RSUs that have been out there, you may have some that are in gain position, you may have some that are in loss position, maybe big gains, small gains, maybe short-term gains, maybe long-term gains. That's where it gets a little bit more complex. And it depends on, what you should do, really does depend. So first thing I would do is make a plan. Don't jump out and start doing things, but make a plan. You consider those things I mentioned before, your need for the cash. In other words, when are you going to spend it? Your concentration in the stock, how much do you actually have? Your diversification across the portfolio. Now, if you have an amount of stock that you're willing to sell all of it today, okay, even if it's old RSUs, then just look at the tax effect of that and understand, especially this time of year, whether you want to sell it in 2021 or do you want to wait until 2022.